Trent Bradshaw Financial Planning, and thank you for joining us for this week's video update. It's really going to be driven toward education. I'm glad to have Brandon Rogers with us today. Brandon joined us roughly about 7 months ago. He's a certified financial planner here at Bradshaw Financial Planning. And again, glad to have him. It's been a huge asset to the company. And please introduce yourself as soon as possible if you haven't met him already. He's going to be able to help you just as much as I am. So again, let's go ahead and use this session today from an education standpoint. We have a couple questions that came in from clients, and we wanted to extend those questions to you and provide answers. I think it applies to a lot of our client base, and again, I think you'll find it useful going forward. So what was the first question that we received from clients?
A lot of times, Trent, what we hear from clients is that, I have all these assets and I do have a lot of pre-tax or traditional type of IRA accounts. Does it make sense for me to convert to a Roth IRA or to start a Roth IRA and contributing to that if I can? So, let's look at the conversion side of things. What's involved with it, and should they do it?
There's a number of things, Brandon, you got to take a look at when you're talking about converting from a traditional IRA to a Roth IRA. Obviously, first thing you want to look at is, what's your current age? How much time do you have in order to allow that conversion? Because you will have to pay taxes on the conversion in the year that you convert. So you're going to have to look at the time frame. I'd say if you've got 10 years plus in order to allow that Roth conversion to grow, it's a valid thing to take a look at. The second thing that you would want to consider is, where's your current tax rate? Is your tax rate above the 15% tax bracket? If it is, maybe you don't convert. Maybe you think about that. Work with your tax advisor. They'll give you direction in regards to whether they think it's beneficial by running the numbers. Obviously, we'll run the numbers for you too, but again, we're going to refer you over to that tax advisor ultimately because you will have to pay taxes on the conversion. But in addition to that, when we're talking about taxes, I think our current tax rates that we have right now are fair. If you look at it historically, tax rates are fairly reasonable at the current rates that we're at right now. So when I back up and I look at a conversion opportunity, if you're in the 15% tax bracket, I definitely think you need to fill that full bucket within that 15% bracket, converting from an IRA to a Roth, and consider that. But the last point is this: if you want to leave a legacy to your family, converting to a Roth could be a fantastic tool, because what happens is you're taking a taxable account, moving it to a tax-free account for the benefit of those beneficiaries. And again, there's no RMD rule associated or required minimum distribution at age 70 and a half on a Roth IRA. Compare that to a traditional IRA, you do have to start taking distributions at 70 and a half. And again, that could impact your Social Security and Medicare and other things throughout retirement in regards to taxes. So again, we would be glad to run those numbers if you have that opportunity, but please ask us about Roth conversion, and of course we can run those studies for you. We also got a second question from clients, and it's in regards to tax reform and potentially repatriation of funds. Brandon will explain what we're talking about there, but they wanted to know how the overall portfolios and the market in general would react to maybe tax reform and that repatriation of funds from corporations. So Brandon, I'll pass it off to you and let you answer that question.
In regards to repatriation of funds and really what we're looking at now and what the administration is trying to do is do tax reform. And it's taking a lot of traction right now. I know the administration wants to get that done by the end of the year. So we'll certainly see what happens with that. It would make a huge difference inside of the market and the accounts and how they perform, because obviously the market's been rallying for a while now, and valuations are kind of high. The market is expensive, and to bring those valuations back in check, if this happens and tax reform does occur, it could bring the market back down to valuations are where they're supposed to be, and we could probably maybe still see this rally continue. But really what they're trying to do in the administration is do tax reform. So right now there's about 7 different tax brackets, right? So what the Trump administration is trying to do is take that from 7 down to 3. So they're looking at 10, 25, or 35% rates on that. So the big unknown and the question is like, where are those income gaps going to be? And that's what we've got to wait and see what happens. So that's one major thing that can affect obviously the individual going forward. And then hence into what another question that Trent had answered with Roths. It could change that scenario too, of maybe even more advantageous to convert. So a lot of things to see there, and we'll stay tuned and keep you up to date as far as what we find out on that end. Second part of that is the repatriation of funds. So what does that mean? That basically is just saying companies that have all their cash overseas, because of the tax rates are so much more better over there, and if you're looking at about 35% corporate tax rates, what we're doing here in the U.S., it's high when you look at the world economy. And so what they're trying to do now is trying to take that tax rate to the 20, maybe 25% range. So therefore, about 2.2 trillion can come over from overseas markets back to the U.S., and that would basically stimulate the economy on its own right there, and would bring those valuations back down. So again, something that really have a huge impact on the market and the accounts as well overall. And basically, we'll just have to stay tuned and see what happens. It's something Trent and I follow obviously on a daily basis. So we'll certainly keep you up to date on that.
Well, Brandon, that's a good point in regards to repatriation, because that's just like quantitative easing, what the government did in buying our bonds to keep interest rates low. If all that money comes back into our economy, again, it acts like quantitative easing. It's a ton of liquidity, and liquidity goes into the market. We think it'll be a positive thing for the stock market from this point to the end of the year and following into 2018. Again, I want to thank you for taking the time to join us today. Hopefully those questions hit home. If you've got any questions for us directly, feel free to give us a call. Obviously, connect with us on social media if you get a chance. Again, we've got the 3 channels that you can connect with us on. And then also, we appreciate your business, appreciate the opportunity to work with you. We look forward to hearing from you soon. Hope you have a fabulous week. This is Trent Bradshaw and Brandon Rogers with Bradshaw Financial Planning. Thank you.
Thank you.